Good morning, everyone. Today is Friday, 28th of September 2012. I think last working day in the month of September, and I would like to welcome you to Windsor Brokers live daily market outlook, our daily release where we discuss and analyze the market movements, see some fundamentals, some news, and some most of the time is technical outlook for major currencies and commodities. As said, we are at the end of the week, and finally some positive sentiment has been established in the markets. The main focus, Spain yesterday released their budget projects for projections for 2013, and basically this was one of the main drivers of the euro and the commodities that bounced higher, with the Spanish government aiming to for spending cuts and then not tax raises. That was the most painful thing for the Spain. However, the protests were still taking part in the German, in the Spanish capital, Madrid. The said government announced a crisis budget for 2013 based mostly on spending cuts and what many see as an effort to preempt the likely conditions of an international bailout. The ministry budgets were slashed by 8.9% for next year, and no public sector wages frozen for a third year as government battles to trim one of the Eurozone's biggest deficits, based by anti-austerity protests and threats of recession by the wealthy northwestern region of Catalonia. The Prime Minister is resisting market and diplomatic pressure to apply for a rescue, partly out of concerns for national sovereignty, but also because European Union paymaster Germany insists that Spain doesn't need help. The central government sees budget savings of 13 billion euros in 2013, with the spending down 7.3%, not including the social security and the interest payments, and the income rising 4% thanks to a 15% leap in value-added tax take. The budget now goes to Parliament on Saturday, and the debates could last weeks, with the country's 17 autonomous regions still must present budgets and find an additional 5 billion euros in adjustments to meet overall public deficit goals. But for now we have quite a positive reaction from the markets. As said, the euro jumps higher after finding a good base at above 28 on 200 days moving average, and significant is a break above 129 and yesterday's close above this level that I would say gives some more credentials for the further extension higher, with the similar situation with the sterling that is back to strength, showing that the current congestion under important 163.00 barrier seen as a corrective, consolidative rather than corrective, as the near-term focus is back towards the upside. Dollar yen is in the weak mode, in descending mode. 2 days ago, a bounce higher did not result in any, did not make any benefits, as the gains were limited at 78, just on approach to 78, and the fresh weakness is now again aiming towards important support zone at 77 area, 77.12, 77.00, with dollar Swiss, as we mentioned, finding quite big difficulties to clear 200 days moving average and the important resistance zone at 94, 94.16, with the second attempt higher failing again, and the quite stronger easing at this point, dipping down to 93.50. We are we'll look into this more into details to see. Just to mention that based on the positive sentiment on the currencies, commodities also benefited. The crude oil bounced significantly higher off its recent low 2 days ago at 88.94, currently holding above 92 level, still away from the important 93 zone, where which is required to be regained in order to avert immediate downside risk, with the gold off its recent highs, just ticks away from the previous peak at 1787, currently trading at 1779 after hitting 1782.50 high this morning. Back to the range, consolidative range that lasts in past approximately 2 weeks, with the downside being well protected for now. From today's calendar, I do apologize again, we have some technical problems with the calendar, so I will just briefly give you the updates for today's calendar. German retail sales already released, slightly below expectation. 0.3 is today's figure compared to 0.5% forecast, but much better than minus 1% in previous release, while French consumer spending came in better than expected. The monthly release 0.4% compared to 0.1 forecasted, and equal to the previous month release. A Swiss Cough Economic Barometer has already been released. It's if you give me a second, we're going to see the release. It came at 167, well above the expectation at 154, and the previous release at 1.59. That shows a quite steady position of the Swiss economy. At 8:30 GMT, we have the index of services from UK, 3 months for 3 months, 0.2% forecast, minus 0.1% of the previous release, and the 9 o'clock is inflation estimation for the Eurozone yearly release. 2.4% is projected the inflation for today compared to 2.6% of the previous release. Spanish banks will be having a stress test results. We don't have time, exact time of release for this. Across the ocean, Canadian GDP starts at 12:30 GMT, 0.1% increase compared to 0.2% in the previous release, showing that GDP is slowing down. From US data at the same time, personal spending is expected to slightly increase. Today's consensus is 0.5% compared to 0.4% of the previous month release, while core PC index is again 0.1 compared to 0%, slight improvement. Personal income for US at the same time at 0.2%, slightly below the previous month release at 0.3%, and then we have important releases. 1345 is Chicago PMI, that is forecasted at 52.9, slightly below the previous month release at 53, but still well above a 50 barrier that divides the growth from the contraction. And the University of Michigan data at 13:55 GMT, consumer sentiment is forecasted below the previous month release at 79.2. At 79 is today's consensus, while inflation expectations, we don't have forecast. 3.5% was the inflation in the previous month, and that's all for from economic indicators. On today, Friday, we have the focus on the Eurozone inflation release at 9 o'clock GMT, and of course the US data along with the Canadian GDP that are going to be the key releases for today. As this was the part of the fundamental and the news part, we're going to take a look now in the charts and see the latest movements, as quite a lot of activities, especially for the single currency and sterling and commodities. I would say positive activities seen in the past 24 hours, as a single currency finds good support at 128.30 zone. We can see it better on the daily chart, where the dips, the recent dips of 131.70 double top were contained by 200 days moving average, and just above the bull trend line connecting lows of 122.54 and 125.00, giving some more credibility now for the possible fresh extension higher, as the bear trend line the trend line of 131.70 has been cleared. This is at 129.00. This is also around the figure and psychological resistance, and the gains extended higher with the 129.40 42 seen so far. This is Asian sessions peak with yesterday's close above 129 as important barrier, and now seeing more potential towards the upside. Quite extended the situation on the hourly chart shows this already hesitation on approach to our next important barrier at 129.60-70 area. We can see it better, I think, here on the no. Give me a second. We have some Fibonacci levels also at this point. Okay. The 129.59 is 38.2% retracement of 131.70 to 128.28 descent, and the previous high and lower top of 25th of September at 129.69. So the pair is now aiming towards this level, and basically if we see the break above here, that will give more credibility to the current bounce higher. Will confirm the near-term double bottom at 128.30 zone, and likely to allow for some stronger recovery. The structure remains positive in both 1 and 4 hour. 4 hour studies are MACD is still below midline, but it's pointing higher, and all the indicators are above their moving averages, and aiming is still towards the upside. That gives more focus towards our upside targets at 129.60-70 zone, seen as initial barriers, with the immediate dynamic support of 10 days moving average so far holding the price action, current easing with the bullish crossover of 20 over 55 days exponential moving averages underpinning the current action higher. Most likely scenario would be fresh extension as the positive sentiment keeps the upside in the focus. Any dips in case of further easing should be contained at or above 129.00 zone in order to keep the near-term bulls firmly in play and open way for a fresh extension higher, while loss of 129 and the broken trend line support currently at approximately 128.90 would weaken the near-term structure and be more bearish. Basically, the loss of this level might result in further ranging above 128.00, while break below this, I would say, critical support for the pair, 200 days moving average trend line support, and both trend lines, basically the bull trend line as support and the broken main bear trend line of a yearly peak concentrated in this area, offer quite a big cluster of supports, and the loss of these levels could be seen as a trigger for a deeper reversal, deeper correction of 2 months rally from end of July low at 120.42. Otherwise, a break above, as mentioned, 129.60-70 is to open next level psychological barrier 130.00, also 50% retracement of 131.70 to 128.28 descent. But regain of initial 129.70 is required to confirm the near-term corrective action, and the signal double bottom pattern as shown better on the hourly chart. That will allow for some stronger recovery. And similar with the sterling, as the pair finds good support at 161.36. There was a congestion and a consolidation after a brief break above 163 with 63.08 seen so far, and as the barrier proved to be quite tough, the further easing occurred when we lost initial support at 162, 161.80. There was more signals at that time for further easing. 161.50 was initially offering support with further extension down to 161.36 when the ground was finally found, and the fresh bounce higher now looking again towards upside barriers. A break above near-term bear trend line of 163.08 through 162.60 gives more credibility to the current move higher. with the regain of another important barrier at 162.66. These are the previous peaks of 25th of September, with 162.71 seen so far, looking more towards the upside and possible retest as we are approaching 163 and 163.08. Of course, the overextended conditions on the hourly chart have already resulted in a slight easing of the recent high at 162.71, with the levels to watch. Immediate support is now being cracked at 10 days exponential moving average, with the 20 days one at 162.30 and the 38.2% Fibonacci retracement at 162.20. I would say the critical point is at 162, where we have approximately 50% retracement and the broken bear trend line, and any break below 162 would be quite bearish in the short term, and would delay the immediate bulls in favor of a deeper reversal, while below 161.88, which is 61.8%, to turn the focus again towards the downside. Downside basically to extend the current congestion under 163.00. Clear break above 162.66 that has so far been penetrated but not clearly taken out. Would look for immediate target at 163 and 163.00. This was our medium-term target high of, short-term target high of 30th of April 2012, also the yearly peak of 2012, and break above this level is basically to signal break above long-term congestion established from 2011 October, and break higher is to focus levels towards 165, where is the trend line resistance, and 166 previous high. Okay, these levels are still slightly out of range at this point, but clear break above 163 is in the short term expected to trigger some stronger gains. Of course, failure to break this one would signal further congestion and further range, as we have at this point we have range trading on the weekly chart, of course. And from Fibonacci studies, 4-hour Fibonacci shows the good support at 162.37. This is the clouds top that basically offers initial support, while more important to the downside, approximately 161.85, with the clouds base and break below these levels, as mentioned previously, 162 and 161.80, that also coincides with the Fibonacci support, would be slightly bearish for the pair, and would again keep the 163 zone intact. And nothing much to say about dollar yen, that rather than the pair is losing ground after a brief bounce on the Bank of Japan official comments 2 days ago, when bounce higher found a quite tough barrier at 77.90, just ahead of 70. This was actually initial barrier, a previous high of 25th of September, and ahead of 78 as a psychological barrier, with the fresh easing and losing 77.58 previous low of 26th of September, extending so far to 77.42. Negative studies, the indicators in the negative territory on both 1 and 4-hour charts keep the downside firmly in focus, as the descending 20 days exponential moving average on the 4-hour chart maintains the current descent, and the main focus now is at 77.12 low of 13th of September, as well as 77.00 as a round figure psychological support. Unless we see clear break above 78, that would be the initial barrier to ease the current bear pressure. A likely scenario would be retest of 77.12, 77.00 zone. And the dollar Swiss, as we mentioned at the beginning, is having some difficulties at 94 zone. Brief break above penetration above 200 days moving average, and test of previous high at 94.16, as yesterday's bounce higher ticked 94.16 still shows that barrier is quite tough, as subsequent easing and reversal down to 93.50 so far. That marks approximately 38.2%. Pardon. 38.2. It's close to 38.2% retracement of the initial up move from 93.27 to 94.16. Keeps the near-term focus more to the downside, as weak studies on the hourly chart are still seeing more risk towards the downside, especially that price moved below all three moving averages on the hourly one, and the 10 days exponential moving average so far capping the upside, as well as a bearish crossover of 20 over 55 days exponential moving average, pressuring the pair additionally from the upside, unless we see a regain of I would say minimum 93.80, 93.90. That will again turn focus towards the upside. Possibilities of further easing are quite high. Important support is previous higher low of 25th of September at 93.26, and quite high risk would be seen on loss of this level, along with the more important 61.8% retracement at 93.05. Close to it is 93.01 trend line support, as well as round figure support. So 93 zone is basically seen as a break point for the dollar Swiss. As break below this level would be signal of sidelining the near-term bulls in favor of deeper reversal, as the larger picture still maintains a firm bearish tone, with the indicators on the daily chart well in the negative territory, as this is just corrective part of the larger downtrend from 99.70 that bottomed so far at 92.37. And if we see the clear failure of at 94 zone, then most likely, of course, the break below 93.00 required to confirm it, then we might see some further easing, and in short term a possible revisit of 93.27 and the extension of the downtrend, as a good part of this downtrend has already been retraced, approximately 76.4% Fibonacci retracement of the latest upleg from 90.41 to 99.70 has so far been retraced, keeping more focus towards the downside on the longer run, as the pair currently tests a broken bull trend line. This is the longer term bull trend line, the short term bull trend line of 19th of February 2012, low at 89.29, and basically break of this and the more important 93 zone would be signal for near term bears that will be likely taking control. Ability to hold above initial 93.26 would be still seen as bullish. Will keep the current uptrend intact for a possible attack at our important barrier 94.16, break of which, of course, to open way for a fresh extension higher. 94.47 seen as an immediate target. That marks a 61.8% retracement of the down leg from 95.77 to 92.37, along with the 90 static barrier 94.82 peak of 10th of September, and the 95.00 as round figure resistance. And the November contract of light sweet crude oil has found some ground at 2 days ago low at 88.94, with the bounce higher triggered by positive news and fundamentals that also affected the currencies. Has regained some ground, bouncing above 92. Barrier 92, as we said, 92.56 I think was the highest seen so far, with immediate dynamic resistance at 92.80 of 55 days exponential moving average. It's important that this moving average is now moving sideways, while the 20 days one is turning up. That is underpinning current action, as studies on the 4-hour chart are gaining momentum and approaching their midlines. More possibilities of further extension higher are seen now. Our next important barrier is at 93 and 93.17. This is the peak of 25th of September. Also the 93.82, the 21st of September highs, along with the 93.44, 38.2% retracement. To summarize, a break above this zone here is required to ease the current bear pressure and probably to allow for some a stronger recovery of the latest strong down move from 100.72, 14th of September fresh peak. That so far bottomed at 88.94. Overall picture on the larger time frame is still quite negative, as the indicators are still in the negative territory, but supportive point is that 90 days moving average on the daily chart so far holds, despite being briefly cracked, holds the downside, and the 55 days one at 93.41 is added to the cluster of barriers previously mentioned, and the break above 93.94, which is also strong barrier, previous strong support, higher platform, I would say is required at this point to avert the price of further sliding, and probably to allow for some stronger recovery towards 200 days moving average. Conversely, break below 88.94 will be signal for a fresh extension lower. This marks also the exactly 50% retracement of 77.27 to 172 ascent, with the levels on the downside seen on a break in 87 zone as a higher platform seen next, ahead of 86 zone of 61.8% Fibonacci retracement of 77.27 to 100.72. And finally, to take a look at gold, and that basically the range is still intact, but more focus, near-term focus is now turned towards the upside and approaching the upper boundary of the past 2 weeks range established between 17, now lowered the floor to 1736, and the upside is 1787. A bounce of 1736 and break above the near-term bear trend line at 1763 now sees more potential towards the upside, as well as a break above 1774 we mentioned yesterday as important barrier. Also a break above the previous highs 1777 and 1779 now turns the immediate focus towards 1787, the previous peak, and of course our upside target zone at 1790. This is the peak of February 2012 yearly high of gold, and 18 zone, the peaks of November 2011. More focus, as said, seen in the towards the upside, although the overextended conditions on the hourly chart signal some corrective action could be quite likely at this point, and immediate near-term supports, in case we see the top, temporary top here, will be seen as previous high at 1774.80. 1771 is at 23.6% retracement, and then we have the 1765 reinforced by 55 days moving average, along with the 38.2% Fibonacci retracement. I would say at the near term, ideally, any deeper reversal should find ground somewhere around the 1760-65 zone in order to keep immediate bullish tone firmly in play, and the possible test of our upside barriers at 1787, 1790, and 1800 in the near term. That was all from my side today. I think I spoke quite a lot. We already have a question. Is it usual to see market drop on last Friday of month? Look, yes, every Friday is end of certain cycle. Whether the last Friday, as a day, last day of the week or last day of the month, it's usually end of a certain cycle, and the most of intraday traders are clearing their positions before the end of the day. And of course, yeah, we might see some profit taking today. That's definitely, especially in this instruments, and most of instruments had quite good movements, especially yesterday and the day before. So yeah, it's quite likely. This is usually, I would say, standard procedure for most of intraday traders, as they are clearing their positions at the end of the day, and especially end of the week. Very few keep the positions during the weekend. We're talking about smaller traders and intraday traders. Of course, the longer term ones are not much bothered with this, but yes, of course, every Friday brings increased action despite the aside from the number of economic indicators that usually come at the end of the week, Thursday and Friday. Of course, Fridays squaring the positions is quite a common thing, and you can watch it close to the end of the US session. You will see a lot of opposite side movements in most of the instruments, especially in those that are the most attractive and the most active. Is there any further question, please? Or we have covered all important things, as I usually say. Sometimes I'm glad if there is no questions. It means that we meet your requirements for the market conditions. Okay, it seems there are no questions. Thank you all for attending our sessions. We think that we are doing a good job, as no complaints so far come, and very few questions. Anyway, as I'm always mentioned, you can see email on the top on the start page, where you can give us all your comments, suggestions, feedbacks, whatever you think could be changed or added. We'll be glad to receive feedback. So far I have received quite good comments, so I think we are on the right track. We want to in a way educate and inform all our attendees about market movements, and as said, as I mentioned previously, also we are planning, I'm planning actually to make a sort of technical analysis seminar that will come quite shortly. I'm quite busy at this period of time, and cannot make it right now, but very soon we're going to make something like basics of technical analysis that we think that that most of our visitors will find it quite interesting and useful. Again, thank you all for being with us. End of the week, watch the markets. Whoever is long, take profit or whatever, if you want to take it at the end of the week. We're back on Monday at our standard time at 7 o'clock GMT. Until then, very nice Friday, very good and profitable trading, and of course nice and relaxing weekend to be fresh for our next week's action. Good luck.